What's up, guys? My name is Joe Davis. I'm a licensed real estate broker here in the state of Missouri. I help people buy and sell homes all the time. I buy and sell my own homes. I do a lot of investing. Something that I've come across here lately, especially with the way the market's changing, interest rates are going up, it's getting more expensive to purchase a home. And I've noticed that most people, when they purchase their first home, they're low down payment. If you're going FHA like 3.5% down or a conventional 3.5% down, I always recommend doing the conventional loan 3.5% down. Thing that gets most people though is that private mortgage insurance, PMI. A lot of people are unfamiliar with that. It increases your monthly payment significantly. And what PMI is, basically it's insurance for the mortgage company. It's protecting them from you defaulting on your loan. One thing that you can do, and the banks typically don't tell you to do this or even let you know that it's possible, but if you're a first-time home buyer and you're buying a house, low down payment, 3.5% down, never go 100% financed, never go zero down payment on any type of real estate. I don't recommend that at all. If you're doing like 3.5% down on an FHA or conventional loan, buy a property that you can fix up and gain at least 30 to 40% equity within your first year. So what you're gonna do, let's say you buy a house for $100,000 and you put 3.5% down, that's $3,500. You're gonna be borrowing roughly anywhere from $95,000 to $97,000, give or take. The numbers are gonna change, but it's neither here nor there. So buy the house, you got a loan for $97,000, you're gonna be paying PMI, your taxes, your insurance, plus principal and interest. And the best way to get rid of that PMI, and this is something that's going to lower your payment drastically, and it's something you should definitely do, get rid of that PMI as soon as possible, because a lot of times PMI won't drop off at all. Like if you get an FHA loan with 3.5% down, you'll have PMI pretty much for the life of the loan. If you get a USDA loan, you're going to have PMI for the life of the loan. If you do conventional, or even if you do FHA, if you buy a house for $100,000 and then you fix it up, you put an additional $10,000, $15,000, $20,000, you update the kitchen, your bathroom, maybe clean up the outside, put a new roof on it, new floors, stuff like that. All things you can do relatively cheap. You don't have to go top notch and deck the place out. You can make that house worth $150,000. You put $10,000, $15,000 into it. You only have a loan for $97,000. Now your house is worth $150,000 because of the updates you just made. What you're going to do is you're going to refinance now at that new rate. You're going to get all your money back. You're going to come in with a conventional loan, and now you have 20% equity, and you don't have to carry that PMI anymore. So that's what I recommend everybody do to avoid PMI. You want to get rid of PMI as soon as possible, lower that payment as much as possible, and build equity in your house. So the only way that you're really going to be able to do this is with an FHA or a conventional loan. You're going to have to buy a property that is slightly distressed. I'm not talking about going out and buying a big piece of shit. Then you're going to have to put 20% down. And if you're a first-time home buyer, most likely you don't have 20% to put down. Best thing for you guys is to get that low down payment, conventional or FHA, fix the property up a little bit over your first year, make it worth a lot more than what you paid for it, refinance about a year later into a conventional loan, do your 80-20 split with the bank, you'll have your 20% equity and you'll no longer have to carry PMI.